In a not-so-unexpected move, Canoo announced on Friday that it had filed for Chapter 7 bankruptcy and is ceasing operation immediately. The EV startup is the latest to call it quits in the face of financial difficulties, and it will certainly not be the last. The last 2 years have been rough on EV startups as the cash resources have dried out, and the opportunities to raise more capital have narrowed. Many were bolstered by Tesla's success and tried to replicate it, but the pandemic and economic difficulties that followed proved to be a tough nut to crack for most of them. The latest to bite the dust is Canoo, a promising EV startup that failed to live up to its hype. Canoo faked success for too long while advertising its pill-shaped lifestyle vehicle and the corresponding multi-purpose delivery vehicle. The EV startup signed partnerships and pilot programs with USPS, US Army, NASA, and the state of Oklahoma but could only deliver a handful of the vehicles it promised. Canoo burned over $1 billion in its short existence and has struggled with liquidity issues for the past 2 years. The most severe blow was in 2023 when the SEC imposed a $1.5 million fine for misleading investors concerning its IPO. The investigation found that Canoo deceived investors with unrealistic revenue forecasts of hundreds of millions of dollars before going public in 2020. Like other failed startups, including Fisker, Canoo has been wildly mismanaged. The 2023 earnings report revealed that the startup spent double its annual revenue on the CEO's private jet. Specifically, Canoo generated less than $900,000 after delivering 22 vehicles to NASA and the state of Oklahoma. The company spent $1.7 million the same year to rent the CEO's private jet. To add insult to injury, the firm involved in the process is owned by Canoo's CEO Tony Aquila. Canoo received $100 million in state incentives to build its Oklahoma production facility without actually producing a single vehicle there. Even those it said it built in Oklahoma were, in fact, built in Texas, according to a whistleblower report cited by K4. Just weeks before filing for bankruptcy, Canoo shut down its Oklahoma facility and furloughed workers. According to the Chapter 7 filing with the Bankruptcy Court of Delaware, Canoo owes money to fewer than 49 creditors, with liabilities ranging from $10 million to $50 million. The startup only has $50,000 in assets. The company will immediately cease operations and head toward liquidation, with a court-appointed trustee overseeing the process. Canoo is the latest in a string of EV startups that ran out of cash and were forced to file for bankruptcy. The opening was made in 2022 by EV truckmaker Electric Last Mile Solutions, but the first high-profile bankruptcy was Lordstown Motors in 2023. Before that happened, famous short seller Hindenburg Research revealed that the startup faked reservation numbers for its Endurance electric pickup truck. Proterra, Lion Electric, and Arrival have also ceased operations and filed for bankruptcy. Intriguingly, Canoo bought Arrival's assets last year, although it's unclear whether it used them for anything. However, all those startups pale compared to Fisker, the biggest company that filed for bankruptcy protection. Unlike all its peers that closed doors after exhausting their cash reserves, Fisker produced and sold many electric vehicles. The bankruptcy made life very difficult for owners of the company's Ocean SUV. They were left with no support, no parts, and no service, and they almost had to pay themselves for the repairs required by safety recalls. Unfortunately, Canoo is not the last EV startup to close shop, only the latest. According to a Wall Street Journal report, at least 18 EV and battery startups were projected to run out of cash in 2024. Among them were Fisker, Canoo, and Faraday Future. While the former two confirmed the bleak report, Faraday Future is not far behind. Another fan fact, Canoo was founded by 2 people departing Faraday Future, only to see their company run into the ground faster than the company they ran from. Nikola, a company that has played with disaster pretty much since its inception, is also very close to filing for bankruptcy protection. Nikola is actually the company that made Hindenburg Research famous in 2020. The short seller discovered that Nikola trucks were not functional, and the allegations proved true, sending CEO Trevor Milton to prison for securities and wire fraud. Nikola announced a new round of layoffs in December after reporting quarterly losses of roughly $200 million. The company disclosed in filings that it only has enough money to operate through the first quarter of 2025. With its hydrogen fuel cell trucks having serious technical issues and huge production costs, Nikola is next in line for bankruptcy. All eyes are now on Rivian and Lucid Motors, both burning cash like there's no tomorrow. Rivian is the undisputed champion, with $22 billion spent in 7 years, more than any other EV startup in history. However, Rivian appears to be on a path to profitability, thanks to finding new backers like Volkswagen Group and a recent government loan worth $6 billion. Lucid Motors is mostly Saudi-owned and less prone to market fluctuations, making it more likely to survive.